This is a lesson from history. Silver will explode and fake money will collapse, just like what happened in the 3rd century during the Roman Empire, when they were dwindling their silver content in their currency. History repeats itself with staggering similarity. This is by Egon von Greyer's Gold, Switzerland. The crisis of the 3rd century and today have much in common, he says. All empires have the seeds of their own destruction within them. So if we look back almost 2,000 years to the Roman Empire, we'll find exactly the same symptoms as what's going on today. Deficits, debts, excessive military spending, debasement of currency, breakdown of trade, plagues, revolts, wars, and hyperinflation. This is exactly what happened in the crisis of the 3rd century, and right now the world is facing the same disasters. When Marcus Aurelius' son, Commodius, became emperor in 120 AD, the silver content of the denarius coin was almost 90%. But when then gradually costs were soaring and revenues declining, and the empire was running out of real money, or gold and also silver, more and more money was required to bribe a disloyal army. By 235 AD, the situation became serious, as many Roman legions were defeated by the Germanic people. The Roman generals also fought each other for control of the Roman Empire, and between 235 AD and 284 AD, there were more than 50 emperors, most of them murdered or killed in battle. The finances of Rome declined rapidly, and debts increased substantially. Taxes were continuously raised, but there were fewer and fewer who were in position to pay tax. From 250 AD, there was also a plague that killed major parts of the population. That was at the time of King Constantine, of the second of the two Roman emperors. He moved and went to Constantinople, which was Byzantium at that time, which is today Istanbul in Turkey. Now, the more it changed, the more it stays the same. By changing the names and years to today in the above paragraph, the situation is almost identical. From the creation of the Fed in 1913, the US and the dollar have gradually gone downhill, but the acceleration phase started in 1971 when Nixon closed the gold window. Again, the similarity with Rome is astonishing. The real decline started in 235 AD when the crisis of the 3rd century began. At that time, the denarius had 50% silver content, which over the next 50 years declined to only 5% silver content. That's a 90% fall. Emperor Galenius presided over this final fall in 260 AD. The dollar has lost 98% since 1971. The situation today is even worse. In the 50 years between 1971 and today, the dollar has lost 98% of its real value measured in gold, and the fall is now accelerating. As the graph shows, the dollar has lost a staggering 83% in the last 20 years since the year 2000. The symptoms are the same, but the dates change. What's absolutely extraordinary is that the symptoms of the 3rd century are identical to today. Deficits, debts, excessive military spending, debasement of currency, breakdown of trade, plague, that is the pandemic, revolts, wars, and hyperinflation. Revolts meaning protests, of course. Now, each one of the above symptoms is present today. We obviously have the debts, deficits, etc. We also have social unrest in many countries, and right now rampant in the US. We also have the plague in the form of coronavirus. So far, there are no major wars, but sadly, with the current geopolitical tensions, the risk is major, especially with China in the South China Sea, for example. Hyperinflation is coming. We don't have hyperinflation yet, which is typically defined as the prices going up by 50% per month, but with the dollar having lost 98% over 50 years and 83% since 2000, it only has 2% to go to zero, and with the massive money printing and credit expansion that's now taking place, I can't understand how anyone believes we can avoid it today. Human beings always think that it's different today just because we're here. But how can anyone think that we can solve a debt problem with more debt? And when we look back at history, Currency collapse and hyperinflation is a very frequent event. Just in the last 100 years, there have been over 60 hyperinflationary events in the world, and in the last 2,000 years, the number could easily be over 1,000. What's totally different today is that the whole world is in a similar situation, and when hyperinflation starts, very few countries will be able to avoid it. A global hyperinflation will clearly be both spectacular and devastating, and it's not a question of if, but when. Many are saying that we have no inflation today, so how can we get hyperinflation? What few understand is that hyperinflation is a currency-driven event. It arises as a result of the currency collapsing, and the currency collapse is due to massive money printing, which we're seeing the beginning of now, especially when we're having all these aids going out because of what's happening health-wise. Now, we are already seeing the first symptoms of hyperinflation in US money supply growing exponentially. Stocks ignore reality. Debts and money printing have been driving stock markets to even dizzier heights for decades. Economic fundamentals and reality have little importance. Just give investors another injection of fake money and they euphorically invest it in the market. It's a perfect end to the fake world. You print worthless money and then buy shares that have a fake value, hoping that the carousel will spin even faster, not realizing that all the riders will soon fall off, and then the music stops and all goes dark. But before the music stops, it's so loud that investors can't hear all the warning signals. And we certainly have had enough warnings. It all started in 2000 with tech stocks crashing 80%. That was also the time when stock markets peaked in real terms, but nobody noticed and people still have not. Stocks down 70%. How can any investor with even an ounce of analytical ability not notice that since 1999, stocks are down almost 70% in real terms? Real terms obviously means gold, since it's the only honest money and the only money that has survived in history. It's also the only money that over the millennia has maintained constant purchasing power. An ounce of gold 2,000 years ago bought a good suit for a man and still does today. It seems that for a great number of investors, stocks are the only investment they look at and believe they understand, but they don't understand enough to realize that these stocks in this century have been an extremely poor investment in real terms. What they can't fathom either is that stocks are now entering a major secular bear market, which will be devastating. To measure stocks in a fiat currency like US dollars does not reveal what actually happened to the investment. Since stocks seem to have gone up substantially in dollar terms this century, investors feel both rich and content. But in purchasing power terms, they have been a losing investment, as measuring stocks in gold reveals. If we look at the chart, the Dow is down 67% against gold in the last 20 years, 67%. The correction to the 1999-2011 fall finished in 2018, and now the ratio is on a way to below the 1-to-1 level which we saw in 1980. Dow and gold were both at 850 then. I believe that we'll see less than 0.5 to 1, which is long-term trend line. The stocks. The relative strength index at the bottom of the chart showing not confirmed the Nasdaq height since 2018. It's very bearish signal, which almost without exception leads to a crash. And another bearish factor is divergence between different indices. The new height of the Nasdaq is not confirmed by the Dow or the S&P. It's also a strong warning signal. Currencies. Since all the currencies are in a race to the bottom, it's always difficult to predict which one will win, and it doesn't really matter since the destiny is the same for all of them. It serves no purpose to hold worthless paper money which will be printed to death. Much better to hold physical gold and some silver. Still, it looks like the dollar is turning down now. The trend is not confirmed yet technically, but I recommend to investors not to hold any major amount in any currency. I believe that the dollar is most likely to fall fast, he said, to fall first. Gold and silver. Silver was at 1556 at the time of the tweet, now at 1830. Silver, leading indicator for the metals, and a recent move is very significant. The important point I made in my tweet was that the gold-silver ratio will collapse, and this is exactly what happened. It went from 110.6 on the 14th to 98.8 on June 2nd, and the fall of 11%. The fall in gold-silver ratio is a prerequisite of rising precious metals, and this means that we now have confirmation, he says. And the ratio will continue to fall towards 30 initially. This means that silver will go to the old high of $50 and above, but it won't be a straight move and there will be major volatility. This is why I always recommend to hold more physical gold than silver. This is by Gold Switzerland, by Egon von Geertz, founder and manager of Matterhorn Asset Management. And I'm reading the article for you. It doesn't mean that I agree with it. And please take care of what you're doing with your investments. And I'll leave links below for you for this. Thank you. If you'd like to join me on my Patreon account, you will hear content not covered by mainstream media. These riveting stories will be based on my research, and I will state my opinions and give my personal insight on diverse and controversial subjects and world events not covered by mainstream media, and not supported by YouTube guidelines. So whatever I have on my Patreon, most of those will not be on my YouTube channel. Please consider becoming a member today. More of the most significant and important videos will be on my Patreon channel. Your support helps me to continue my research and keeps this YouTube channel alive. And we depend on your support, your generous charity, because we help economically challenged families here in Athens, Greece, in Kapota, and we also help the young generation with university tuition and the community around our church. Thank you.